Welcome back. Now, the South African Reserve Bank's Monetary Policy Committee, that's the MPC, is expected to announce its interest rate decision, and that will be happening later today. Now, the central bank lowered its repo rate to a 5-decade low in 2020 at 3.5%. The Monetary Policy Committee has cut the interest rate by 3 percentage points since the beginning of 2020, and 275 basis points of that easing was actually in response to the impact of the COVID-19 pandemic and also in support of the economic downturn which resulted from the pandemic and the induced lockdown. Now, in March, committee members unanimously decided to keep the interest rate on hold. Meanwhile, Statistics South Africa, they yesterday reported that consumer price inflation increased from 3.2% in March to 4.4% in April. We're joined now by Dr Bheki Mfeka, who's the director at SE Advisory and former advisor in the Presidency, to share his expectations ahead of this afternoon's MPC decision. Dr Mfeka, good to have you. Welcome to Morning Live.
Thank you, Sakina. Good morning to your viewers.
So we're still very much in the grips of a pandemic, and of course those who have interest rate decisions that impact adversely on them are watching this very keenly. But let's just start by taking a look at the sort of the considerations that are taken into account by the MPC in coming to a decision. Which are the most pertinent ones?
Well, the policy is very clear for the Reserve Bank. We call it inflation targeting. Their main consideration is that the inflation must be between 3 and 6%. As long as it is within that bound, it's quite safe. And they consider a lot of factors as well in the economy, like your growth rates and many other factors, unemployment and government expenditures, exchange rates, and so forth. It's a combination of factors that gives the impression to committee members as to the direction the interest rate should take, all in the interest of targeting and preserving the integrity of the currency.
So yesterday's Stats SA indicating that the inflation rate has jumped from 3.2% in March to 4.4% in April. And this is, of course, the highest since before the lockdown, when it was at 4.6%. But we also told it's been driven by transport and rising food prices. So this obviously something that we should be concerned about?
Yes, we should be concerned. I think the inflation targeting policy has limitations because in it there are contradictions, especially when you consider inequalities, unemployment, which is extremely high. So when you consider the fact that the current pressure for inflation comes from, for instance, oil prices, which affect transport, food, and other value chains, that pretty much tells you that it doesn't take much into account the conditions on the ground as a result of, for instance, the current pandemic, which means that as there has been a lot of arguments from different stakeholders that perhaps it's high time that the policy is reviewed to be broader, to target more developmental issues, to deal exactly with inequalities. Because you may find that we are within the range of 3 to 6% inflation, but the situation on the ground is worse. For instance, we have 32% unemployment, which is the highest in the world. Inequalities are the highest in the world. But yet you still may see that your indicators are good, you're fine with 4.4% is within the range, even 6% would be fine. But many people are unemployed. So the bank currently protects, it would seem, given the inequalities, it protects the banks, the currency, which is pretty much fine. But those banks are not accessible by the majority of the people, Africans in particular, who are unemployed. Whether the interest goes up or down, for them, it's about bread and butter, to have food on the table. So it's kind of aloof to many people, the kind of policy that we have.
And it's a good point that you make, Dr. Mfeka, and this has been one of the criticisms of the central bank for a very long time. But apart from inflation targeting, what are the other tools at their disposal in coming to these decisions?
Well, the current policy is limited to inflation targeting. They have other tools that they have used recently because of COVID. Remember when they pumped in some money into the market just to make sure that the bond market continues to be viable. Yes, and also they assisted the land bank, which was extraordinary. So they can, and they should. I don't really understand what's the problem with our policymakers, if especially under these circumstances, Sakina. You got to use your central bank effectively to deal with the challenges you face.
So if we were to try and understand or perhaps even come up with further alternatives, as you say, right now, this is an opportune moment for the central bank to actually start looking at different options and doing things differently. What would be some of the pushback from their side, if you and I were playing devil's advocate, as to why they wouldn't do it?
Well, the problem is historical, Sakina. You remember the ANC, when it came into power in 1994, it was not even allowed to easily appoint its own ministers. They had to appoint a national party finance minister, precisely because the markets are the preserve of certain group previously advantaged group, and which is still predominantly the same even today. So for the ANC to change policy, it treads very carefully because they might find that they are severely criticized or punished by those who are in charge of the markets. You know what I'm saying? And you find out that in many instances, the ANC could not even tamper with the current conservative macroeconomic policy. In the monetary policy terms, there is modern monetary policy, which has moved along from the so-called Washington consensus. And with a monetary space that we've had, we could have changed the policy with confidence, with integrity, because integrity is more important, and transparency. You can even convince the markets that the trajectory we're following does not help to reduce inequalities, does not help to reduce unemployment, doesn't even bring about growth that we want so much. So to keep on using the same policy and hope to get different results does not make it. So we have that challenge. There are many other instances where the hands of the ruling party were tied. And it gets even worse when there are factional battles and there's also corruption that is taking place. Then it means you can't even touch those kind of policies, to make, because you're not trusted by those who have control of the resources.
So this is very depressing, but it is also not new. It's not surprising, and it's a question that I often ask of ANC leaders, because even when people speak, you get the sense that they are not in charge. And I often ask, if you don't know, who should know? So who is in charge?
The people who are in charge everywhere in the world, Sakina, it's people who own resources. In South Africa, we often say it's mineral energy complex. The people who control our mines, gold, platinum, coal. Of course, the environment changes from time to time as the market changes. You have new players. Even global players are in control of our economy. We have a small open economy where the states really has peripheral duties, which more when it comes to the market. They are precisely on more social type of, and also infrastructure to a certain extent. With fiscal space having shrinked, the government will have no leverage whatsoever. They will have to go to the market to get the money. If your Reserve Bank is not capable of claiming its authority as a nation, then you rely on debt to do what you want to achieve as a country.
And speaking of debt, we've been borrowing, and again, servicing that debt becomes a problem in and of itself. But I also just want to squeeze this question in. There was a statement from the MPC in which they said that the internal modeling that is used as a guide suggested that interest rates should be starting to rise from the second quarter. This against the backdrop of a pandemic that is very much still with us in a country that seems to be well on its way to a full-on third wave of this pandemic. What should we make of that?
Exactly, Sakina. There I'm saying, the decision of the Reserve Bank will sharply indicate the contradictions and the inadequacy of the policy, inflation targeting policy, because precisely you will not even think of raising interest when when the conditions are like this, when people have lost jobs, when people have are in poverty as a result of the pandemic, and this is a continuation of a build-up from previous challenges that we already had. So the fact that we have a catastrophic unemployment and inequality, that tells you that you have to be on your toes when it comes to policy instruments that are effective to change. Well, until your space is completely not there to do anything, then you rely on other people.
Dr. Mfeka, we're out of time, but I just have to ask you your anticipation for what's to happen today. Given the current climate, some would hope that there would be space for more cuts, but obviously that doesn't seem to be a popular view. But what are you anticipating for today?
Well, with the current position of the bank and its leadership, it's clearly not going to go down. They will maintain at the list, and I don't think they will increase it under these conditions. If they do, then my position remains that the policy is not for many people in this country.
Dr. Mfeka, thank you so much for your time. Dr. Bheki Mfeka, of course, talking to us about today's MPC decision on interest rates, and just talking more expansively about some of the issues that the bank has to contend with, and also decisions being made and what the basis is that they are being made on. So it's going to be an interesting one this afternoon. Dr. Mfeka thinks it will hold, and many other economists think so too. But of course, if it were up to you and I, Leanne, we would have hoped that there would be a cut, but as Dr. Mfeka says, probably won't happen.
Yeah, more than likely it looks like it that way. All right, I think that's where we're leaving it for this morning.